All right, listeners, let's get into it. It's November 7th, 2024, and we're going to do a deep dive into GMM Pfaudler's second quarter financials for fiscal year 2025. Our goal for today, we want to see if we can figure out if GMM Pfaudler is on track for growth, or if there's some red flags we need to watch out for. Now, for those who don't know, GM Pfaudler is a big player in the world of industrial equipment. They make reactors, mixing systems, storage tanks, all that kind of specialized gear for chemical, pharma, and food processing companies. We've got a bunch of information to sort through today. Their official announcement to the stock exchange, a detailed investor presentation, and the full financial statements themselves.
It's like we've been handed the company's diary.
Exactly. So let's start with the big picture. What are the headline numbers telling us?
Well, GMM Pfaudler reported a consolidated revenue of 805.42 crore for Q2 FY25. That's up 3% from the previous quarter, but down 14% compared to the same quarter last year.
Okay. So a mixed bag there. But wait, didn't I see something about restated numbers for Q2 of last year?
You've got a sharp eye. Yes. Those Q2 FY24 figures have been adjusted because of acquisitions GMM Pfaudler made during the last fiscal year. They went back and reworked the old numbers to include the performance of those new businesses so we can compare apples to apples. It makes things a little more complicated, but it gives us a more accurate picture.
Got it. So revenue's up against last quarter, but down year over year. Taking those restatements into account, what about profit?
Well, their consolidated profit after tax for Q2 FY25 came in at 17 crore. That's a 29% drop from the previous quarter, and a 75% drop compared to Q2 FY24.
Wow, that's a pretty steep decline. Should we be hitting the panic button yet?
Not necessarily. Those year-over-year numbers look scary. But we need to remember those restatements from the acquisitions are playing a role. It's important to look at EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It measures a company's core operating profitability.
Okay, that makes sense. So what does their EBITDA look like?
Their consolidated EBITDA for Q2 FY25 was 93 crore. That's a 6% increase compared to Q1, but a 34% decrease compared to the restated figures for Q2 FY24. Interestingly, though, their EBITDA margin, EBITDA as a percentage of revenue, remained pretty stable at 11.6%, just slightly up from 11.3% in the previous quarter.
So their profit took a hit, but their operating profitability remained pretty steady. That seems a little contradictory. What's going on there?
Well, remember those finance costs we talked about earlier? They've actually increased compared to last year, likely reflecting the higher interest rates we're seeing globally. This rise in finance costs, it's likely tied to their recent acquisitions, but it's also mirroring the global trend of rising interest rates. We're seeing that across the whole industrial equipment sector.
Yeah. So higher interest rates are eating into their bottom line, even though their core operations are still generating decent profits.
Yeah.
Before we move on, I have to ask about something that caught my eye. They declared an interim dividend of €5 per share for this fiscal year. Isn't that a bit unusual given the drop in profit?
It's definitely interesting. It could suggest that despite the lower profit, management still feels confident about the company's financial position and future prospects. They might be prioritizing rewarding their shareholders while also reinvesting profits in long-term growth initiatives that might not show immediate returns, but are expected to boost future performance.
Okay, so maybe it's not time to panic just yet. But let's not get ahead of ourselves. We need to dig deeper into these numbers to get a clearer picture. Let's move beyond those top-level financials and see what else we can uncover. What do you think we should look at next?
I think a closer look at their order intake and backlog. That'll give us a better sense of what the future holds for GMM Pfaudler. After all, strong order intake today means more revenue and a hopefully profit tomorrow.
You got it. So let's talk order intake. This tells us how much new business GMM Pfaudler secured during the quarter, right?
Precisely. And for Q2 FY25, their consolidated order intake stood at 762 crore.
Okay. And how does that stack up against previous periods?
Well, it's slightly lower than the 861 crore they achieved in the previous quarter, Q1 FY25. But when we compare it to the same quarter last year, it's actually an 18% increase from the 626 crore order intake in Q2 FY24. And if we look at the first half of the fiscal year as a whole, their order intake has reached 1,644 crore. That's a solid 18% jump from the 1,396 crore recorded in the first half of the last fiscal year.
So despite a little dip compared to the last quarter, the overall trend in order intake seems pretty positive. They're bringing in more new business. But what happens to all those orders? They don't all get fulfilled in the same quarter, right?
You're absolutely right. That brings us to the order backlog. It's essentially a waiting list of orders that the company has secured but hasn't yet fulfilled. Think of it like a restaurant with a line of people waiting to be seated.
Okay, I get it. So how long is GMM Pfaudler's waiting list?
Well, as of September 30th, 2024, their consolidated order backlog stands at 1,773 crore.
Wow, that's a lot of orders waiting to be filled. What does that tell us?
A healthy order backlog is generally a good sign. It indicates a strong pipeline of future business, which should lead to a more stable and predictable stream of revenue in the coming quarters. Of course, it's not a foolproof guarantee. Things happen. Projects get delayed, sometimes even canceled. But overall, it's a positive indicator.
All right, so we've got a decent sense of the company's overall health and future prospects. Their revenue is a bit mixed. Their profit is down. But their core operations seem solid, and they have a lot of future business lined up. Now let's roll up our sleeves and get down to the nitty-gritty of those financial statements.
Let's dive into the details.
The statements break down revenue, expenses, and profit on both a consolidated and standalone basis, meaning we can look at the whole company together or just focus on their Indian operations. Where should we start?
Let's start with the consolidated figures for the quarter. We already know GMM Pfaudler generated 805.42 crore in revenue. What's interesting is how that revenue is split between their operations in India and their international business.
Okay, so looking at the segmental breakdown, it seems the revenue from India came in at 196.24 crore, while the international business contributed a significantly larger chunk of 609.8 crore. That means almost 76% of their revenue this quarter came from outside of India.
Precisely. And this split's pretty consistent with what we've seen in previous periods. GMM Pfaudler is a truly global player. Now let's see how their expenses break down.
All right, so the biggest expense is the cost of materials consumed, which makes sense given that they manufacture equipment. This cost came in at 285.13 crore for the quarter. Next, we have employee benefits expense at 219.50. And then there's depreciation and amortization expense at 33.26 crore. Finance costs, which we talked about earlier, amounted to 26.47 crore. We also see some other expenses like labor charges at 19.97 crore and a broad category of other expenses totaling 147.34 crore.
Now, if we connect these numbers to the bigger picture, they tell us a couple of important things. First, the cost of materials consumed makes up a big portion of their total expenses. This means that any fluctuations in the price of raw materials, like steel or other metals, could have a big impact on their profitability.
So if the price of steel goes up, their profits could go down, even if they're selling the same amount of equipment.
Yeah.
Got it. What else do these expenses tell us?
Well, we also see that their finance costs have increased compared to last year. This is partly due to those acquisitions we discussed earlier. Integrating new businesses and restructuring often involves taking on additional debt, but it's also reflecting the broader global trend of rising interest rates, which makes borrowing more expensive for everyone.
Right, so they're dealing with both internal and external pressures on their costs. Now, after deducting all these expenses, what are we left with?
After all those expenses are taken out, their consolidated profit before tax for Q2 FY25 stands at 33.03 crore.
Okay, and after accounting for taxes?
That brings us down to a consolidated profit for the period of 17.28 crore, which is the number we saw earlier.
Okay, so that covers the consolidated figures, the performance of the entire GMM Pfaudler Group. But what about their Indian operations specifically? How do they do on their own?
Well, that's where things get a bit more interesting. The standalone statements, which focus solely on their business in India, show a slightly different picture.
Okay, let's hear it. How did the Indian arm of GMM Pfaudler perform in Q2?
Their revenue from operations in India for Q2 FY25 was 208.02 crore. That's actually down 7% compared to the previous quarter and down 22% lower than the same quarter last year.
So while their international business seems to be holding relatively steady, their Indian operations are facing some headwinds.
It appears so. And this is where analyzing their performance by segment becomes really crucial. By looking at the performance of different business units and geographic regions separately, we can get a much clearer understanding of the factors driving their overall results.
Okay, I'm starting to see how this is like detective work. We need to examine all the different pieces of the puzzle to get the full picture. So for now, let's stick with these standalone numbers a bit longer. What else jumps out at you?
Well, if we look at the expenses for their standalone Indian operations, the cost of materials consumed was 98.73 crore. Employee benefits expense came in at 25.99 crore, and depreciation and amortization amounted to 7.81 crore. Their finance cost for the standalone business was 7.36 crore.
And after deducting all those expenses, what was their profit before tax for Q2?
Their standalone profit before tax for Q2 FY25 came in at 10.55 crore.
Right. And after taxes.
That translates to a standalone profit of 7.82 crore for the quarter.
Okay. So a smaller scale operation compared to the consolidated figures, but still a profitable quarter for their Indian business. So what's the key takeaway from all these detailed breakdowns of revenue and expenses?
I think what's fascinating here is the contrast. While their consolidated performance is influenced by this complex web of global factors, their standalone numbers give us a much more focused look at the specific challenges and opportunities they're facing within the Indian market. Analyzing both sets of figures side by side gives us valuable context and helps us develop a more nuanced understanding of their overall business.
Okay. So we've covered their revenue and expenses, both consolidated and standalone. But there's another crucial piece of the financial puzzle we need to examine before we can move on to the juicy stuff. Their segmental performance.
You're talking about cash flow, right? Absolutely critical. You can't get the full story without understanding how cash is moving through the business.
You read my mind. Let's dive into their cash flow statement, see what we can uncover.
Let's do it.
Okay, so we're about to dive into the world of cash flow, which can be a bit of a mystery for some people. Can you give us a quick rundown on why cash flow is so important? It seems like everyone is always talking about revenue and profit. Why is cash flow the lifeblood of a business?
That's a great question, you see. A company can be profitable on paper, meaning their revenue exceeds their expenses. But they can still run into trouble if they're not generating enough cash to keep things running smoothly. Cash flow is all about the actual money coming in and going out of the business. It tells us if they have enough cash on hand to pay their bills, invest in new projects, and weather any unexpected storms that might come their way.
Okay, I'm starting to see why cash flow is so crucial. Like making sure you have enough money in your checking account to cover your rent and groceries, even if you have a high-paying job. So let's look at GMM Pfaudler's cash flow statement and see how they're managing their cash. Where do we even begin with something like this?
Well, the cash flow statement is divided into three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Each section tells us a different story about how the company is using its cash.
All right, let's start with cash from operating activities. What does that tell us?
Cash flow from operating activities is basically the cash generated from the company's core business operations. Think of it as the cash that comes in from selling their products and services, minus the cash that goes out to pay for things like raw materials, salaries, and rent.
Okay, so it's a measure of how efficiently they're converting their sales into actual cash.
Yeah.
What does GMM Pfaudler's cash flow from operating activities look like?
If we look at the consolidated cash flow statement for the first half of FY25, it shows that GMM Pfaudler generated 117.35 crore from operating activities.
Okay, and how does that compare to the same period last year?
Now, this is where things get interesting. In the first half of FY24, they actually used 9.57 crore in operating activities. So we've seen a pretty dramatic swing from using cash to generating a significant amount of cash from their operations.
Wow, that's a huge turnaround. What happened? Did they suddenly become super efficient at managing their cash?
There are probably a few factors at play here. It could be that they've improved their working capital management, which basically means they're doing a better job of collecting payments from customers quickly, keeping their inventory levels under control, and negotiating favorable payment terms with their suppliers. It's also possible that some of their strategic initiatives, like those acquisitions we talked about earlier, are starting to bear fruit, leading to more efficient operations and higher cash generations.
So it's like they've tightened their belts and gotten their financial house in order. That's a good sign. Now, what about the next section? Cash flow from investing activities. What does that tell us?
Cash flow from investing activities shows us how much cash the company is spending on investments in things like property, plant, and equipment, as well as any acquisitions they've made. Essentially, it reflects their investments in their future growth.
Okay, so it's like looking at their spending on assets category. What does GMM Pfaudler's statement tell us about their investing activities?
In the first half of FY25, they used 24.59 crore in investing activities. This isn't necessarily a bad thing, though. It's mainly due to investments in property, plant, and equipment, likely related to their growth plans and the integration of those acquired businesses. They're spending money to make money in the future.
Right. They're putting their cash to work to expand their business and stay competitive. Makes sense. And what about the final piece of the puzzle? Cash flow from financing activities.
Cash flow from financing activities shows us how the company is raising and using cash related to its financing. This includes things like issuing new shares, taking on debt, paying dividends to shareholders, and repurchasing their own shares.
Okay, so it's all about how they're managing their capital structure, their mix of debt and equity. What does GMM Pfaudler's cash flow statement reveal about their financing activities?
For the first half of FY25, they used 42 crore in financing activities. The main driver here seems to be the repayment of borrowings and lease liabilities.
Because they're being fiscally responsible and paying down their debt. That's a good sign.
Yeah. Absolutely. It shows they're committed to managing their debt levels and maintaining a healthy balance sheet.
All right, so we've looked at all three pieces of the cash flow puzzle.
Okay.
Operating activities,
Hmm.
investing activities, and financing activities. What's the overall takeaway here?
If we look at the net increase in cash and cash equivalents, meaning the total change in their cash position, GMM Pfaudler ended the first half of FY25 with a positive increase of 50.76 crore.
Okay, so their cash position actually strengthened during the first half of the year. That's pretty impressive.
It is, especially when you compare it to the same period last year, when they had a net decrease of 36.65 crore in cash and cash equivalents. So they've gone from losing cash to generating a surplus.
That's a pretty remarkable turnaround. It seems like they're managing their cash much more effectively this year. But before we get too carried away with the cash flow excitement, I think it's worth taking a quick detour to glance at their balance sheet.
Agreed. The balance sheet, remember, is like a snapshot of the company's financial health at a specific point in time. It shows us their assets, liabilities, and equity.
Right. And while we don't have time to go through every single line item, there are a few key areas we should keep an eye on.
Absolutely. For instance, it's always wise to keep an eye on their debt levels. As of September 30th, 2024, GMM Pfaudler's consolidated borrowings, meaning their total debt, stood at 747 crore. That's a slight increase from the 712 crore they reported at the end of the last fiscal year.
Okay, so their debt has gone up a bit. Is that a cause for concern? Should we be worried?
Not necessarily. It's important to look at this number in context. Their investor presentation actually highlights that their net debt-to-equity ratio improved to 0.3 times as of September 30th, 2024, compared to 0.4 times at the end of the last fiscal year.
Hold on, can you explain what that ratio means? It sounds like a bunch of financial jargon to me.
Of course. The debt-to-equity ratio is a way to measure a company's financial leverage. It tells us how much debt they're using to finance their assets compared to their equity, which represents the value of the company that belongs to its shareholders. A lower debt-to-equity ratio is generally considered to be better because it means the company is less reliant on borrowed money, which can be risky, especially if interest rates rise or the economy takes a downturn.
So even though their total debt has increased,
Mm.
their equity has grown at a faster rate, resulting in a lower debt-to-equity ratio. That means they're actually in a stronger financial position, right?
Exactly. It indicates that they're managing their debt responsibly and their overall financial risk is decreasing.
Okay, that makes me feel a bit better. What else on the balance sheet should we pay attention to?
Another important area to look at is their working capital. This gives us a sense of their short-term financial health, how well they're managing their day-to-day cash flow. GM Pfaudler's investor presentation actually provides a pretty detailed working capital summary. Their inventory days, net of customer advances, which is a measure of how long it takes them to sell their inventory, stood at 43 days as of September 30th, 2024. That's up slightly from 40 days at the end of the previous fiscal year.
Okay, so their inventory is sitting around a bit longer this year. Is that a bad thing?
It's not necessarily a red flag. It could just mean that they're strategically building up inventory in anticipation of higher demand in the future. It's something to keep an eye on,
Yeah.
but not necessarily a cause for concern.
All right. What about their receivable days? That's a measure of how long it takes them to collect payments from their customers, right?
Exactly. And that number remained relatively stable at 47 days as of September 30th, 2024, compared to 46 days at the end of the last fiscal year. This suggests they're doing a decent job of collecting payments from their customers on time.
Good to know. What about payable days? That's how long it takes them to pay their suppliers, right?
You got it. Their payable days actually decreased slightly to 41 days as of September 30th, 2024, compared to 43 days at the end of the last fiscal year.
So they're paying their suppliers a bit faster than before. Is there a reason for that?
It could be a strategic decision to negotiate better terms with suppliers, or it could simply reflect their improved cash flow position. Either way, it's a positive sign.
Okay. So it seems like their working capital metrics are all within a reasonable range. They're managing their inventory, receivables, and payables effectively.
Overall, I'd say their short-term financial health looks pretty solid.
All right. We've gone through their income statement, their cash flow statement, and even glanced at their balance sheet. I'm starting to feel like we're getting a pretty good grasp on their financial performance.
Me too. But remember, these are just the numbers. We need to see what the company itself has to say about its performance. What's their story?
Right. Let's put on our storytelling hats and see what kind of narrative GMM Pfaudler is weaving in their investor presentation.
Let's see what they're highlighting.
All right, so we've got the hard numbers from their financial statements. But now let's see how GMM Pfaudler is spinning things in their investor presentation. Are they emphasizing the positives, downplaying the negatives,
Yo.
or giving us the straight scoop?
Well, they kick things off by highlighting those key performance indicators for Q2 FY25, revenue of 805 crore, EBITDA of 93 crore, and profit after tax of 17 crore. They also mention that big order backlog of 1,773 crore.
Okay, so they're leading with those headline numbers,
Right.
which paint a bit of a mixed picture, as we've discussed. But what's the overall story they're trying to tell?
They're definitely focusing on the positive trends. Even with those year-over-year declines, they point out that both revenue and EBITDA are up compared to the previous quarter,
Yeah.
3% and 6%. They also emphasize that their EBITDA margin, that measure of their core operating profitability, remains stable at 11.6%.
So they're highlighting the stability and resilience of their business. Even though those profit numbers might make some investors nervous, it's like they're saying, don't worry, we're still in good shape.
Exactly. And they're drawing attention to their order intake, which is showing positive momentum, especially for the first half of the fiscal year. A strong order intake is like fuel for future growth. It means more revenue and hopefully higher profits down the line.
Makes sense. They're painting a picture of a company that's not just weathering the storm, but also actively positioning itself for future success.
Precisely. And to back up this narrative, they highlight some key points from their balance sheet and cash flow statement. They're proud of that improvement in their net debt-to-equity ratio, which indicates a strengthening financial position and lower risk. They also point out that their working capital remains stable, suggesting they're managing their day-to-day cash flow effectively.
It's like they've cherry-picked the data points that reinforce their message of stability, resilience, and a positive outlook for the future. They're definitely putting their best foot forward. Now, what about investor reaction? Did the stock price move after the results announcement? That can often tell us how the market is really interpreting the news.
That's a great question. Unfortunately, the sources we have don't mention any immediate stock price movements.
Yeah.
And they don't offer any commentary from analysts either.
Okay, so we'll have to wait and see how the market digests all this information. But based on what we've seen so far, I'd say GMM Pfaudler's Q2 performance presents a bit of a mixed bag. There are definitely some challenges, particularly in the Indian market and with that decline in profit. But there are also some positive signs. Strong order intake, a stable EBITDA margin, and an improving financial position.
I agree. It's a nuanced picture. It's not all sunshine and rainbows. But it's not a complete disaster either. We need to dig a bit deeper to understand the full story.
Okay, so we've looked at the consolidated figures, the standalone numbers, the cash flow statement, the balance sheet, and even considered the company's own spin in their investor presentation. We've covered a lot of ground. But there's one more area we need to explore before we wrap up this investigation.
You're talking about their segmental performance, right? Breaking down their performance by geography and business unit.
You got it.
Yeah.
We touched on it briefly when we looked at the revenue split between India and international. But now it's time to really dive deep and see what's driving those overall results. This is where we can uncover the hidden strengths and weaknesses, the emerging trends and opportunities that might not be apparent when we just look at the big picture.
Absolutely. Segmental analysis is like using a magnifying glass to examine the fine details. It can help us see things that might otherwise go unnoticed.
So let's start with that geographic split. We already know that GMM Pfaudler's business is divided between India and international operations, and that their international business is the bigger revenue generator. But what does the segmental data tell us about the relative performance of these two areas? Are they both equally profitable?
That's a great question, and the answer is not quite. While the international business contributed the lion's share of revenue in Q2 FY25, generating 609.18 crore compared to 196.24 crore from India, the difference in profitability is even more striking.
Okay, give us the numbers. How do their profits compare between India and international?
This segmental breakdown of profit before tax and interest reveals that the international business generated a much higher profit of 42.67 crore in Q2 FY25, compared to 16.83 crore from the Indian operations. And this difference is even more pronounced when you look at the first half of the fiscal year. The international business recorded a profit of 87.01 crore, while India generated just 38.63 crore.
Wow. So not only is the international business bringing in more revenue, but it's also significantly more profitable. What can be driving this difference? Are they just better at doing business overseas?
There are probably several factors at play here. Differences in market dynamics, pricing power, cost structures, and even the product mix could all be contributing to this gap. It's also possible that the international business is benefiting from economies of scale, meaning their larger size allows them to spread their fixed costs over a larger revenue base, making them more efficient.
So it's not necessarily that they're doing anything wrong in India. It's just that the international market might be more favorable for them right now.
Okay, so geography is definitely a key factor in understanding GMM Pfaudler's overall performance, but what about their different business segments? How are those performing?
GMM Pfaudler operates across three main segments: systems, technologies, and services. Let's take a closer look at each of these.
Great. Let's start with systems. What does this segment actually do, and how did it perform in Q2? The system segment's all about those big, complex pieces of equipment, the engineered systems and components used in various industrial processes. Think reactors, columns, storage tanks, and all those pieces that make these industries run. In Q2 FY25, the systems segment brought in 384.64 crore in revenue, accounting for almost 48% of GMM Pfaudler's total consolidated revenue.
Wow. So almost half of the revenue comes from systems. They're clearly a major player in that market. What about technologies? What do they do?
The technology segment focuses on more specialized components and technologies that complement their systems offering. Think sealing systems, mixing equipment, heat transfer solutions, the things that enhance the performance and efficiency of those larger systems. In Q2 FY25, this segment generated 154.74 crore in revenue, representing roughly 19% of the total consolidated revenue.
All right. So technologies is smaller than systems, but still a significant part of their business. What about services? What do they offer?
The services segment is all about after-sales support, maintenance, repair, upgrades, and other value-added services that help their customers keep their equipment running smoothly and efficiently. This segment contributed 266.04 crore in revenue in Q2 FY25, representing about 33% of their total consolidated revenue.
Hold on. That's surprising. Service is actually their second largest revenue generator, even bigger than technologies. I didn't see that coming.
It is interesting, isn't it? This highlights the importance of those aftermarket services in generating recurring revenue and building long-term customer relationships. Those are crucial in the industrial equipment market.
Okay, so we've got a good sense of the revenue breakdown for each segment. But what about profitability? Are some segments more profitable than others?
Unfortunately, our sources don't provide a clear segmental breakdown of profitability, but we can still glean some insights by reading between the lines.
Okay, I like where this is going. Give us your detective work. What can we infer about their segment profitability?
Well, the investor presentation highlights that the order intake for the systems segment has been strong, increasing by 23% in Q2 FY25 compared to the same quarter last year. This suggests that the systems segment is likely a key driver of the company's overall profit growth. After all, those big, complex systems usually come with higher profit margins.
That makes sense. A strong order intake for systems should translate into higher revenue and ultimately bigger profits for the company. What about the other segments? Any clues about their profitability?
The investor presentation doesn't specifically highlight the order intake for the technologies and services segments, but they do mention that the product mix is evolving, which could indicate that they're seeing growth opportunities in these areas. Perhaps they're shifting their focus towards higher margin products and services within those segments.
So while systems is clearly a powerhouse for GMM Pfaudler, it's possible that the other segments are also playing a role in driving their overall performance, even if the details are a bit hazy.
Exactly, and that's why segmental analysis is so valuable. It allows us to peel back the layers and understand the unique dynamics of each part of the business. It's like putting together a jigsaw puzzle. Each piece contributes to the overall picture.
Okay, so we've examined GMM Pfaudler's performance from every angle now. We've looked at the consolidated figures, the standalone numbers, their cash flow, their balance sheet, and even delves into their segmental performance.
Yeah.
We've dissected the numbers, scrutinized the trends, and even tried to read between the lines to uncover their strategy. But what does it all mean? What's the verdict?
That's the million-dollar question, isn't it, ultimately? The goal of all this analysis is to understand what these numbers tell us about GMM Pfaudler's future prospects. Are they headed for success, or are there storm clouds gathering on the horizon?
Right. So based on everything we've uncovered, what's your assessment? Is GMM Pfaudler on the right track? Or are there warning signs we should be heeding?
Well, I think it's fair to say that GMM Pfaudler is navigating a complex and ever-changing business landscape. The global economy is uncertain, raw material prices are volatile, and competition is fierce. But despite these challenges, the company has shown resilience. They've maintained a stable EBITDA margin, strengthened their financial position, and are now generating positive cash flow from their operations.
So they're weathering the storm. But can they thrive in the long run? Where are the opportunities for growth? How can they increase their profitability and create value for their shareholders?
That's where their strategic initiatives come in. They've made significant investments in acquisitions, expanding their global reach and adding new products and services to their portfolio. They're also actively evolving their product mix, adapting to changing market demands and exploring new technologies and applications.
So they're not just sitting back and hoping for the best. They're actively taking steps to shape their future.
Exactly. And that's a key takeaway from this deep dive. GMM Pfaudler isn't just reacting to market forces, they're being proactive and strategic in their approach to growth.
Okay, so that's GMM Pfaudler's Q2 performance in a nutshell. A mixed bag of challenges and opportunities with a healthy dose of strategic maneuvering. It's a complex story, but I think we've managed to untangle some of the threads and shed some light on what's really going on behind those numbers.
Absolutely. And remember, this is just one snapshot in time. The true test of a company's strength is its ability to adapt, evolve, and thrive over the long term. We'll have to keep an eye on GMM Pfaudler and see how their story unfolds in the coming quarters.
Well said. And for our listeners who want to delve even deeper into the details, we'll be sure to include links to GMM Pfaudler's investor presentation and full financial statements in the show notes. Don't be shy. Go explore.
And remember, this is just the beginning of the conversation. Financial analysis is all about asking questions, looking for patterns, and forming your own informed conclusions. Don't take our word for it. Do your own research and see what you uncover.
That's right. This deep dive is just a starting point. We encourage you to continue exploring, keep learning, and stay curious about the world of finance.
And who knows, maybe you'll uncover some hidden gems that even we missed.
That's the beauty of it. There's always more to learn, more to discover. Thanks for joining us on this deep dive into GMM Pfaudler. Until next time, keep those brains buzzing.